2016. The Chinese market on its own, in a way, is a good benchmark for what we think is happening worldwide. If we look at the evolution of the thermal generation, most of it being fueled by coal, it has declined on a yearly basis at an average of 2.9% since January 2015. So no doubt we are seeing a fall in total coal usage in China. And by the way, we think that the Chinese peak is behind us in terms of coal demand and coal imports. Nevertheless, the domestic coal production is declining now at an even faster rate of 4.5%. And it has been the case since January 2015. So as a result, we have seen inventories in China falling, and they are now below historical levels. And we start seeing such patterns in many countries in the world. India, in terms of inventories, being maybe an exception, but we might be seeing interesting times now where we might in fact start to see a rebalancing in India as well, but I will not talk too much about India. Europe is also a good example. We are expecting a sharp fall in UK and Spanish steam coal imports this year. The UK, we expect a fall of about 10 million tonnes, and Spain about a fall by about 6 million tonnes from 2015. But nevertheless, we have now seeing prices for APA2 which we haven't seen since at this time last year. Also, what has been helping is obviously that some of the Colombian coal has been diverted to India and the Pacific, up to 4.5 million tonnes. So this is really where we see the support for the spot prices. It's really this decrease in supply which is really affecting the market and helping to rebalance the market. Now the back end of the curve, for those of you not familiar, when we were trading in January, February, the back end of the curve, Cal 17, 2018, API2 for instance, was the financial contract we are trading at a discount of, depending on the product, $10 to $15 discount to the spot. And it was because at that time there was an expectation in the market that well, coal demand will fall further, that the market will remain in oversupply, and that therefore prices will fall further. But many things have been turned upside down since January. Firstly, we have seen a strong rebound in crude oil prices, with the Brent contract increasing from $27 or $28 per barrel, now flirting with the $50 per barrel. And this has had a direct impact on the cost of production, directly via the diesel cost, which represent a significant amount of the cost of production of coal and transportation, inland transportation worldwide, but even more importantly, an indirect impact via the strengthening of coal-denominated currencies. And we just put here as an example the recent evolution of the Russian ruble versus the US dollar, which peaked at above 80 ruble per dollar in January, February, and which is now at around 64, 65. We saw the same thing for the Colombian peso, which almost reached the 3,500 level and now is back below the 3,000 level. So we have seen a significant increase in the currencies for many coal exporting countries. And in fact, if we now look more into detail at the cost curve itself, we estimate, based on our database and models, that this is here the percentage of increase of the cost curves, the average cost of production for the main exporting countries. Since the low, sometimes the low has been reached in January, sometimes the low has been reached in February, depending on the country. But between that time, let's say, the dark hours of January, February, compared with today. And as you can see, Russia, South Africa, and Colombia in particular have seen a sharp increase, according to us, in their average cost of production. And this is also important because these three origins are probably not the most significant and the main drivers for the API2 market. And the API2 market itself has become the main benchmark for coal pricing worldwide. Even though the volumes of physical coal imported to Europe have declined, the API2 contract and the API2 index are in fact the common benchmark, and a lot of people in the world are trading coal without a physical position, and they will only trade API2 basically. So we saw reaction directly from this cost curve affecting the API2 market, and then it triggered also to the other contract worldwide and FOB. If we zoom in now to the Russian cost curve, for instance, this is a snapshot of one of our cost curve here for Russia, updated recently. And as you can see, it is a very flat curve, meaning that any change in the assumption in terms of oil prices or currencies will move not only a few miles, but will move the entire curve quite significantly by a few dollars at least. So we are moving a lot of tonnage, let's say export of Russian coal, about 100 million tons. So 100 million tons of exports to potentially Europe or the Far East are reacting very quickly to any changes in the cost curve. And in the downward spiral we went in before the 4.5 bear market, the Colombian and the Russian exporters were really competing hard for market share in Europe. But nowadays we start to see a disconnect between the cost curve of production in Russia and the cost curve of production in Colombia, with the cost curve of production in Russia staying higher because of probably the increased influence or the larger influence of oil prices on the Russian economy compared with the Colombian economy. So we start to see now a disconnect between these two cost curves, and therefore we think that now the Russian cost curve, to which we need to add obviously the freight cost to ARA, is becoming to a large extent the price setter for the European market. We are also seeing an increased concentration of exports and supply in Colombia, and because the market has shifted, we think that now exporters and mining companies worldwide, but in particular in Colombia, are starting to have a bigger bargaining power against their buyers. And we think that South African exports are going to remain concentrated on India, Pakistan, and Egypt. This means that at the end of the day, Europe is still dependent very much so on Russian and Colombian exports. So as a conclusion, we think that most of the factors that triggered the recent rally in coal prices could in fact remain in place in the coming month. We expect further cuts in coal production worldwide. We expect a postponement or even the cancellation of new mining projects worldwide, in particular in Indonesia and Australia. We still expect a relatively supported demand and import demand, even if it's within a structural trend of erosion. So we envisage a deficit in seaborne flows from 2017 onwards. I repeat that in bold, at current price levels, of between 8 up to 30 million tons per year. Meaning it doesn't mean there is not enough coal, it means that according to us, prices will have to increase further to attract again this additional supply. We envisage further upside for oil prices in 2016. We see that the Brent contract could potentially go, for instance, to the $55 a barrel. And therefore, we expect further strengthening of coal currencies, in particular the Russian ruble and the Colombian peso, which would provide further upside for most coal curves and coal contracts. And on the top of that, I'm not detailing that into this presentation, but we expect further upside in freight prices, with also a global rebalancing taking place in the freight market. Thank you very much.
Thank you, Guillaume. Next up, we have Rodrigo, who is Head of Energy Coal Analysis at Noble Resources in Singapore. Rodrigo started his coal career as an operations analyst at Cerrejón, Colombia in 2004, and after 3 years of working at the Cerrejón mine, he joined the marketing arm of the company, which is CMC, in Dublin. In 2011, Rodrigo joined Adara Indonesia, where he held various positions in sales and market strategy, and his sales book covered the Greater China region from 2012 until 2014. Previous to Noble, he was a research fellow at King Abdullah Petroleum Studies and Research Center in Saudi Arabia. On to you, Rodrigo.
Sorry, let me get the system going on my side and try to do this. Can you guys see?
Yes, we can see.
the presentation. Okay, so we are good. Okay, so is it okay? Okay. Okay, sorry, it's on the wrong screen. It doesn't matter, I guess. Okay, just it's one little glitch. Okay, so I want to, okay, for good or for bad, the points of Guillaume are similar to the points I have to make. I want to show some, I guess I'm probably going to reverberate on some of them by showing our S&D and showing the conclusion, which is similar from the perspective of our numbers here at Noble. So the time frame I'm doing here with this presentation is 16 to 20. So it's got a bit of the feeling of you know what most people here care about the next 5 years in the coal industry, but some of it can be extrapolated beyond. So the first thing I wanted to show is that actually today Goldman Sachs released big news. They have revised their oil forecast to actually $60 a barrel after being quite bearish just in about January. Goldman Sachs was known to be a big bear in the market. So, you know, things change. And as we have seen, now they are saying commodities have rallied on the back of dovish Federal Reserve, Chinese economic data, positive Chinese economic data that is, and supply disruptions. So they are taking the view that actually at the moment they are downgrading equities to neutral and commodities upgrading commodities. So that was just a little bit of a fun slide there just to show what Goldman's is thinking. So from the perspective similar to what Guillaume was saying in terms of the trend for the coal market, there is this graph that I've made when I was in CAPSARC, and it shows how the market, actually the coal market is going through a very long, in the past, it did go through a very long cycle of low prices, so between 91, so I rewinded a bit farther back than Guillaume, and so you can actually see a bit of a longer period here of low price, because I've been asked this question before by people who are a bit older than me, you know, can we have the same thing that we had in the 90s in the coal industry? But I mean, if you think about it, there is one big difference. You would be compelled to actually say, yeah, this is a depressed market, you have some demand erosion, it's uncertain, etc. But the problem is the size of the green bubble here. The bubble in the 90s is between 150 to 200 million tons. So in the 90s, that market that remained depressed, prices in the 40s for a long time, that was actually a 200 million ton market. So as you go on and you have all of this trajectory here and you have China coming, etc., you have actually a market that is now five times the size of what the market was in the 90s. And that actually makes a difference. Actually, it's harder to keep down a market that is this big just because you need the supply, and you put that against any cost curve, and that actually will give you a clear message. So I mean, that's that point on in general historical perspective, which Guillaume did a little bit of that, but I wanted to go even farther back to the 90s to compare. So I don't see any real evidence that it's actually easy to go back to a situation like the 90s. Now, Chinese futures, just a bit more color on that. Guillaume talked about this a little bit. This is a graph of the futures coal prices in China. We see the bottom here in January, just in January. I mean, we are not talking about 5 years ago. The September 16 contract was below 300 RMB. And the market, by the way, at that time, the market was backwardated. So, you know, if you had the May contract trading and the September contract and some of the Jan 17, I guess. So at that time, the Chinese market was backwardated, and September was that low. And actually, I guess on the 17 was going up a little bit more, but September was below May. So that was the shape of the curve in the Chinese coal market itself. So as we we have come from January to May. We actually hit a peak. Take, for example, the January 17 contract. We hit a peak of over 400 RMB, and it's now coming off a little bit because the market in China had a very good run, and there was a bit too much strength on the iron ore market. I guess Guillaume will probably comment on that later, but it's come off a little bit. For example, yesterday it was trading very strong. So we had a good rally in China that is supported a reactivation of all the arbitrages that were closing in China. If you looked at the ARBs a few months back from Australia, etc., they were starting to close. But at current Chinese market levels, the ARBs are open for a lot of origins. So it's difficult to justify that the Chinese have done all of this just to buy imports. They won't, but it's also difficult to justify that we are in the same spot that we were in January this year. So the next slide is about India. So in India, I'll just show a couple of slides here, and mostly is to show a bit of the methodology of what I'm trying to do when I get to the S&D. This is a very short version of our long-term S&D. But so basically, if you take some of the most conservative estimates of demand in India, so you have a coal demand going to about 1 billion tons demand 2020, about 1.3 billion tons in 2030. This is not their own. This is we just took a conservative case. So then the question is not of demand, more of supply in India. So what happens is that you start having questions, and these bars here show the different producers in India, which one is Coal India, and then you have Singareni, and then you have captive blocks, which is all the private mining sector in India. So you need to take views on them, and actually I give a lot of credit to Coal India, but I don't quite think that they are going to get to 1 billion tons of production by 2020. So, you know, I did a bit of analysis on each of the subsidiaries, and I concluded that it's doable for them to actually hit a number just above 700 million tons. So that's one finding. And then the other finding with Singareni, we give it growth, and we stack it all up, and we take a view on the captive. Because the captive has not really been a success story in India, and the whole stack, actually, if you remember the announcement, the whole Indian stack to get to 1.5 billion tons, you need 1 billion tons of Coal India and other government companies, and 500 million tons of private mining. So we take a view that actually by 2020 India will probably be able to do just about 900 million tons. So let's take just look at how that balances. So the balance in the form of this table going from total generation, etc., taking a view on each of them, including quality actually, it gives us some bad news. So actually to 2020, I wouldn't be particularly bullish India, but there is one finding here, and is that actually there's a bit of a peak in 2015 with 169 million tons, and probably losing a little bit this year. But the issue is going to be by 2020, all of the production that is going to come online in India is going to be start to getting stretched. So you are actually straining the infrastructure, and you start having again problems with linkages, because what they are doing now is a lot of the low-hanging fruit. So my conclusion is actually even India, specific India, the supply-demand balance in India actually tightens, and it requires a bit import growth again post 2020. So that's a bit of a long-term view, but I think it's interesting to know that even though we're a bit bearish India in the short term, we're not really that bearish India in the long term. Okay, and so now bringing everything together, I have to say this S&D here, we are quite conservative. You can see, for example, on the Chinese numbers, we're very moderate on the numbers. We don't think Chinese imports are going to grow back to where they were in 2014. But overall, when you add everything up, you get to actually 2015. Guillaume said, I was talking, I think, about a contraction of 70 million tons. This shows a similar number. and you get to 876. So from the 2015 point, which is our base year, to 2020, actually, we get a little bit of growth in demand to 25 million tons. Quite conservative case. I cannot emphasize that enough. But you have spots of the market that give you a bit of growth. Southeast Asia, India is a bit weak there, but Northeast Asia gives you some. Europe actually phasing out, trying to phase out, and some Mediterranean and America. So what you end up is with this 900 million ton number here. So that's not a very exciting picture there from the supply-demand balance perspective. However, the slide that I find drives the point is this one. So when you get to the whole supply picture with the demand picture, actually, when at current prices, also agreeing with Guillaume there, I would rather this is done freezing prices and seeing what happens to supply. So what happens to supply? Indonesia, really, we talk to Indonesia daily, and at current prices, Indonesia really struggles. I mean, you actually you could say, you know, they get by, etc., over the challenges of finance, for example, the mines are facing, and the increasing cost structure, which is the low-hanging fruit, also gone there. So Indonesia a bit strained there. Australia enjoying very good capacity, etc., but no green fields, so you cannot really add any numbers. So if you see how the numbers progress, there's not a lot of excitement coming other than Colombia, which is a low-cost producer, and South Africa, which is also relatively low-cost producer, so they can compete, and they have available capacity to expand. Those countries that can do that, they will expand, but not the case of Russia. Again, the ruble, really a challenge for them right now. It's turned against them, so they're really going again, becoming marginal again in the supply stack. So once you add all of that up, you end up with the balance at the bottom here, and the balance not guaranteeing you right now that this -16, which means undersupplied, will happen this year. This number is sensitive, so it can move a little bit. But what the trend shows is that it becomes increasingly tight, and it's using a very, very conservative demand line and using a very reasonable supply case, which is at these prices who's going to invest in coal, basically. So the countries that need greenfields will not do anything about it, and we just go on for 5 years, let's say, with no recovery. So what happens is quite a clear tightening, and I don't see any way around it. And unless we might let Hayden try to beat me up on that. But let's see how it goes. Finally, there's a slide on cash costs. So we run a bit of sensitivities, and then we bring down the margin of the whole market to just 800 million tons. Let's say, you know, catastrophe. So really bad demand, etc. So, but then it becomes clearly very dependent on oil prices, but much more so on currencies. So to me, taking a view on coal prices actually is taking a view on currencies almost. And what it says is that in order to have low coal prices, you have to have very depreciated currency. So you need a very low peso. You need peso in order to keep the market surviving at $50. You need the Colombian peso at 4,000. You need the Indonesian rupiah at 16, 18,000. You need so all of these things have to happen all simultaneously. Otherwise, what you end up having, and from the oil side as well, you end up having some upside. So it brings you the question, you know, so can you sustain these levels? And is this situation with supply that you see in our conclusion, is this something that will suggest actually that the market has to provide some incentive to coal companies in order to sustain some level of production? And that brings you to the point of why the oil market tends to be in contango, and why the gas market tends to be in contango, and why the coal market is supposed to be backwardated. That is not very clear to me. The market itself, well, I mean, sometimes the market does it to itself. Okay, sure, fair enough, if you have overcapacity, etc. But this market is a market that seems to be rebalancing, and it should be in the same shape that other markets are, which is contango, the same as oil, the same as gas, etc. So it's no different from any other energy commodity. There is got to be some incentive for the market to continue to operate. So, and that's the end of my presentation. Thank you very much.
Thank you, Rodrigo. We're going to have Hayden speaking next, but before Hayden speaks, I'd just like to remind the participants that you can submit your questions for our speakers in the chat box in the bottom right of your screen. Please just type your questions into there, and if you could put the name of the speaker who you'd like to ask first, that would be very helpful. So next up we have Hayden Atkins, who is a consultant focused on energy markets based in New York. He's responsible for the Argus Seaborne Thermal and Seaborne Metallurgical Coal Outlook publications, and he also contributes to the Bespoke project. He is an economist, and before this role he worked as a macroeconomist at Macquarie Bank. Thank you, Hayden.
Yeah, thanks very much, everyone. I think when we first came together to decide what to talk about and what our views were, we were all kind of on a similar page in terms of whether prices had reached their bottom, but that didn't make for much fun. So I drew the straw of playing devil's advocate. Those are people that kind of know me, probably know me more as a more bullish or positive person on prices, but it's always important to examine the downside risks. When we kind of put together our forecasts, we're always trying to test them, you know, as strongly as we can against the assumptions of what may go wrong, and usually on the downside, you know, more so on the upside, I think, you know, has been the case for the last couple of years. So I think when we kind of look at the downside risks to prices, they've obviously reduced a lot because we're at a point where pricing is so much lower, and we are seeing that supply adjustment coming through that Guillaume and Rodrigo have kind of outlined. And I think if we are going to get lower prices at some point, it's probably not going to come from supply some greenfield projects may still happen. There was a push to move tonnages to try and improve productivity. I think now, you know, it's kind of reduced costs at all costs, and you know, it's not so much about moving as much tonnage as possibly can. I think most suppliers are looking to cut back more so than anything else. But there's still structural challenges on the demand side of the equation. I think a lot of the price improvement that we've had recently, you know, some to do with kind of FX and broader energy markets, but we also have seen a cyclical improvement in some of the aspects of demand that were quite negative, particularly within China, but it hasn't kind of erased some of these big overhanging risks when you look at kind of energy demand and some of the more macroeconomic aspects of that influence coal markets from a you know 50,000-foot view. I think also it's important to recognise that, you know, these markets are really marginal. So like not a lot has to go wrong for prices to move downwards. And similarly on the upside, I think, you know, coal perhaps it hasn't moved as much as some other commodity markets, but say metallurgical coal, for example, you know, prices that's there have moved very, very sharply over a short period of time on what's really been a very modest improvement in demand as supply has been cut. So I think, you know, we've got to recognise that the balance of these markets, you know, while we look at things annually over a long time horizon and talk about, you know, tens of millions of tonnes, I think, you know, what ultimately moves prices kind of sharply higher or lower, you know, from quarter to quarter is a very marginal change in some of these aspects of markets. And I think really the downside risks are going to come from weaker than expected demand. I don't think it's really going to be a supply story. I think, as, you know, Rodrigo kind of detailed, you know, some of the cost aspects, you know, maybe currencies and oil prices may swing things, but even in that aspect, I don't think producers are going to be, you know, looking to push supply into the market at, you know, prices at even where we are today or a little bit higher. So just touching on the kind of macro energy FX risks, it's clearly very, very fluid. So, everything was kind of heading in one direction in 2015 and early 2016. Some of the risks there have changed, but has kind of, I guess, some of the structural aspects that drove some of these things, ultimately been reversed. Can we rule out a kind of further broad strengthening of the US dollar? We're kind of sitting back from that at the moment because there's been a bit of a shift of the risks of higher interest rates in the US, but that risk hasn't gone away, and especially versus some of the performance of some of the other major economies. We're still in this situation where US interest rates are likely to rise, faster than elsewhere in the developed world. And I think RMB depreciation had a huge impact on financial markets and commodity markets earlier this year. A lot of concern about capital flight. They've kind of stemmed that risks in the last few months, and I think probably some of the better economic numbers are supporting that as well. But looking over the next 1 to 2 years, I think there still is this risk that the RMB will depreciate. It could be quite violent at times. It's something that's kind of difficult to control, and I think that could periodically have a very big impact on kind of the real arbitrages for coal into China, and also some of the financial risks around changing. And with oil prices as well, we've seen a very big rebound. I don't think, as Rodrigo kind of highlighted earlier, people are shifting their forecasts from being kind of bearish to bullish. But I think structurally something has changed about the oil market. We have had this kind of structural change in OPEC supply. So I think the risks to oil prices, while we may not get back to that $28 a barrel on Brent that we saw earlier this year, I think the risks to prices, from a 1 to 2 year horizon, it's not just up. And that's something that can have a fairly big impact on coal. And also natural gas prices, we're seeing big changes coming through LNG markets where, that's going to have an impact on European gas and coal pricing as well, over the next 1 to 2 years. So when I try and think about what's been happening in coal markets and what kind of pushed prices to where they ultimately ended up earlier this year and late last year, there's kind of a range of things, some of which have been kind of structural in nature, and some of which have been kind of more cyclical. So things that we wouldn't expect to persist over the longer term. So this chart is just kind of a qualitative review of some of those things that have been impacting demand for seaborne coal in particular. So we have actually got some positives in that bottom left-hand corner. Really ASEAN growth and some of the Mediterranean countries there, structurally are importing more coal, and will continue to do so for the next few years. Demand in North Asia, some of the big importers there was kind of neutral in 2015, but we kind of had this slew of negative aspects. Some of them are very structural in nature, so European coal displacement, something that's going to be ongoing for quite some time, and really the Chinese push to reduce coal-fired energy usage is also something that's not going away. The plans for renewables, hydrogeneration, nuclear, that's something that had a big impact on coal usage within China last year, and will continue to do so over the next 5 years or so. Some of the more cyclical aspects, I think the mild European winter is something that you wouldn't be forecasting to shift prices lower, maybe this time next year. But some of those things in the middle ground there, I think, are things that were very negative for coal pricing in 2015, but perhaps are not going to be as negative or aren't as negative now, and have maybe shift those price risks a bit. So if we kind of look where some of these things have moved, relatively in early 2016, I think the Chinese industrial slowdown is something that's gone from being very negative and perhaps partially cyclical to something that's really less negative in terms of demand, but it's still kind of this structural risk to coal demand going forward. So it's not like we're moving into a structural positive. Some of the improvement there has really been cyclical, but there really is this structural problem with industrial sectors within China, so overcapacity, a shift in the macroeconomic makeup of the economy. These are all things that are going to be weighing on that aspect of coal demand for quite some time. I think the slow Indian consumption story of 2015, we're talking about total consumption rather than just imports or domestic. You know, it was relatively slow in the first half of 2015. It only grew at sort of 5 or 6%, which is you know, well below expectations. But in early 2016, it's actually been growing very, very strongly. You know, sort of closer to 14 to 15 demand, and I think is something that's kind of helping keep some price benchmarks where they are at the moment. And the Indian domestic production growth story, I think, has also become less of a negative in early 2016 as well. So some of that has been enforced by high stockpiles, but also parts of that equation have been relatively weak over the last 12 months in particular. So those captive coal blocks that Rodrigo was talking about have you know, really underperformed, and I think some of the coal buyers without coal linkages are kind of turning to seaborne markets, you know, as a result. So we've kind of gone from this situation where we had a lot of things that were, you know, really negative to demand, where we've moved to a situation where some of these things are really just becoming less negative. But they haven't gone away altogether. We still have some of these, you know, structural overhangs, and, you know, when we do get these cyclical changes, I think, you know, that's where we do have the risks of you know, reaching new lows in prices when you overlay it perhaps with some of the broader macroeconomic and energy risks. So just looking at some of those cyclical aspects of weakness that have been reversed, there clearly has been a big change within China at a macroeconomic level, particularly for construction. A lot of this has been to do with the efforts to support activity after things slowed, you know, really quite sharply throughout 2015. So interest rates have been cut for quite some time. We're seeing credit indicators, money supply start to turn. You know, that's kind of usually the first step before we see real activity start to improve. So we're seeing property markets turn around. We've seen construction and new starts, you know, really start to lift. You know, that's really changed the risks to demand. But I think, is this something that's going to be persistent? There's a, you know, huge amount of uncertainty as to how long that will last. There's still a lot of overhang in property markets, infrastructure investment, and credit in particular, I think, is where most people are concerned about the longevity of some of the modest improvements we've seen in some of these indicators. So I think, you know, to kind of sound the all clear on Chinese industrial activity and how that affects energy demand and coal on the basis of this kind of modest improvement, cyclical improvement, you know, maybe a little bit premature from a demand side perspective. I think on the coal, Indian coal-fired generation side, you know, it's really worth pointing out how strong it has been in Q1 versus, you know, the first half of last year. So this hasn't really translated into stronger import demand. But particularly if you look at the private sector generation there, it's been explosively strong. You know, the April numbers were stronger again than what's on that chart, and early May, you know, has kind of continued this trend. So we kind of think that's going to shift the risk to Indian imports coming into the second half of the year, and, you know, we are starting to see this have an impact on some of the I guess less efficient state-run plants where stockpiles are also starting to come down a little bit too. But a lot of these kind of cyclical changes, you know, don't eliminate the structural challenges, and these are going to be around for quite some time. So I think particularly around China is where most of the concern lies. And you know, perhaps rightly so from a demand perspective. So we've got a shifting composition of the economy, which is, you know, less energy intensive. So in terms of power demand, you know, heavy industry is you know, roughly 2/3 of demand. So, you know, a lot of challenge to that part of power demand to, you know, stay above water. And, you know, periodically could be very, very negative. We also have this kind of financial and foreign exchange risk overlaying China as well. So very high debt levels that cause concern for you know, a sharp downturn in activity, and also the prospect of RMB depreciation, which could you know, really heavily impact bulk commodity markets in particular. There's also this regulatory push in terms of reducing pollution, and I guess in the last year or so that's been, I guess, more focused on imported coal market in early 2015. I think market participants have learned to deal with that over the last 12 months, but you know, we kind of can't rule out further restrictions on usages of certain types of coal in the future. I think, you know, we're moving more in the direction of tighter restrictions, you know, rather than a more laissez-faire kind of approach that, you know, preceded the more recent rule changes and taxation changes. And there's also this constant push for alternative generation. You know, hydro generation expansion has probably slowed down a bit. You know, that's kind of a year-to-year proposition in terms of how much generation we'll actually get. But wind, solar, nuclear, all we have this kind of fade out in power demand. You know, that can quickly change the outlook for coal burn. And then kind of looking more broadly at some of the risks outside of China. You know, we have this carbon regulatory risk, you know, tightening things in Europe, you know, ultimately or constantly trying to push away from coal. You know, that's not going away anytime soon. And also boosting renewables generation in other markets. I think, you know, we're all projecting growth in kind of ASEAN and other emerging economies, but the rate of that growth, you know, may shift, you know, given some of the broader pressures to try and combat some of the global carbon pressures. So, you know, I'm not saying that those economies aren't going to grow and grow quite, you know, probably quite quickly, but the speed of that growth, you know, may change over time. Finally,
Hayden,
this kind of push for yeah, sorry.
Yeah, would you be able to finish in about a minute's time? We're just pushing on for time.
It's the last slide. I've got just one more point.
Okay, good.
Yeah, so finally just this domestic production push from India that's really changed the outlook for imports there. And, you know, it has seemed to be that domestic supply side problems have been easier to solve than the demand side so far. So if that just kind of continues to be the case, you know, that's kind of an overlaying issue to keep in mind in terms of the downside risks to coal demand and prices. So that was all I had to say, and I'll wrap it up there.
Thank you very much, Hayden. That was a very interesting presentation. We're going to go straight to the Q&A. So to start, I've got a question for Rodrigo. So there are indications that the Australia Reserve Bank will move to lower interest rates and weaken the Aussie dollar. Will this put downward pressure on coal prices for the next 12 months?
Well, so my number there on the S&D was 200 million tons, which I imagine if the Australian dollar goes down, they want to do some expansion. The capacity to expand further is not going to be there. However, also since what you mentioned happened, the Australian dollar hasn't really reacted. So we don't really see evidence of this happening. And even if it happened, I don't think there's going to be a supply reaction, a major supply reaction in this. You would need to see more tons in the market. And I don't think you will actually see that 200 million tons that is in our assumption.
Okay, thank you. Hayden, do you have any comments on that?
Yeah, I guess, you know, the Aussie dollar's actually been quite strong, you know, along with broader commodity markets. So I guess if it did fall, you know, maybe we would be kind of heading back to where we were at the start of this year, kind of, you know, somewhere between 65 and 70 cents. But I think it comes back to, what Rigo says about the reaction of physical supply, would we actually get more tons? Probably not. And Australia hasn't really been, proven to be kind of a marginal swing producer. That most of the supply response has so far really come out of Indonesia and the US, and the Indonesian rupee has actually been, really quite resilient in this kind of strong US dollar environment. And as Guillaume kind of pointed out earlier, we've had pretty big rallies in some of the Atlantic-based producer currencies. So I kind of don't see it as this, big risk to pricing because, we've kind of got this broader currency equation, and again, Australian supply isn't, very flexible. I don't think I'd be changing my supply number, if the Aussie dollar fell.
Hayden, you're supposed to be bearish, right?
Well,
the bears are struggling today.
Okay, so we'll move swiftly on to the next question. And this is for any of the speakers to answer. But concerning the forecasted reduction in Indonesian exports, how do you see the pressure on Supramax and Ultramax freight rates?
I think, Guillaume, you can take that one.
I could answer a little bit on that one. Yeah, I mean, we see the structural decline that we expect in Indonesian exports putting potentially quite a bit of pressure on smaller size ships, so Panamax and below, because still most of or a significant part of the Indonesian exports are taking place on Panamax, Handymax, Supramax. Things have changed. I mean, you still have a few large ports where you can load cape sizes in Indonesia. Indian imports, for instance, have changed as well. So Indian ports now, almost 50% of the Indian imports are actually based on cape size. But if you look at other destinations such as Vietnam, for instance, growing destination, Vietnam, Egypt, all these new importing countries, let's say, still a lot of them will take vessels that are smaller than capes. So we could see an interesting pattern here. We could see a decrease in exports from Indonesia, which on one hand could put downwards pressure on the freight rates for the smaller vessels. But on the other hand, these new importing countries, they will still need to buy some coal from on this kind of vessel size. So we might actually see a kind of shift with bigger size exporters such as Australia or South Africa, let's say, able to load on cape size, increasingly focusing on the normal or the usual markets such as Japan, South Korea, China to some extent, and Indonesia maybe now focusing more on these new targets in the Southeast Asia. But overall, in terms of absolute tonnage, we see a reduction in Indonesian exports, and therefore putting more pressure on the smaller size vessels.
Thank you. And does Hayden or Rodrigo have anything to add to that? I'll take that as a no.
Yes, a no.
Okay, so another question. So a few of you mentioned about the Middle East and Turkey providing some extra structural demand to the seaborne market. But what about Mozambique and Mongolia and other potential coking coal sources? How might that affect the coking coal prices, do you think? Hayden?
Yeah, I think the economics of those projects have really changed dramatically, at prices that are even quite a bit higher than today. So, Mongolia in particular is struggling, and I wouldn't see that as a region aggressively displace a Chinese domestic production or even seaborne imports, nearly as much as when we were kind of thinking about these markets kind of destruction in seaborne markets, particularly outside of the US. I don't think it's kind of this overwhelming, kind of negative force for prices. Again, I think for coal markets in general, it's not so much a supply story that could shift prices lower. I think it's probably more a demand side thing. And I think for coking coal, maybe Guillaume, you can jump in on the back to maybe talk a bit more about steel and iron ore. But we've kind of had this radical bounce in steel prices in China, on this kind of pretty modest improvement in demand, and a very big increase in trading in steel and raw material products within China. So we've had this kind of very violent movements in prices. I think there's probably more uncertainty about how long that demand can persist for steel and raw materials in China. Maybe Guillaume, you want to talk a little bit about that?
Yeah, we would agree with that. We think that we are now in bubble territories in terms of iron ore imports in China and steel production. Overall, we think that the peak in terms of steel production in China is not so long ahead of us. So we don't see, for instance, the famous 1 billion ton of steel production being reached ever. There was an important restocking in iron ore stocks at Chinese ports in Q1, which triggered the rally in Capesize freight we have seen to a large extent. But we think that now this rally should lose momentum because we don't see where basically all this iron ore is going to be consumed.
Fantastic. So I think because we're now past 2 o'clock London time, it makes sense to officially close the webinar here. We can see that there's some questions being asked that we haven't had a chance to answer. So if you'd like to, you can follow up with those questions afterwards. We'll have a look through and see which ones we can get the speakers to answer, if they'd be so kind. But I'd like to thank the speakers now for their preparation in this webinar. We really enjoyed your presentations, and for everybody else, we hope to see you at the World Coal Leaders Network in October this year. Thank you, everybody. Goodbye.
Thank you very much. Bye.